So, when you look at the financial results of a company that actually manufactures physical hardware, and by that I mean, bending metal, etching silicon, managing global supply chains of actual physical atoms.
Right, the heavy stuff.
Yeah, exactly. There's a gravitational pull on the numbers. Like you might see steady revenue growth or, maybe a respectable 40 or 50% gross margin if they have just incredible pricing power.
Sure, which is rare enough in hardware.
Right. But you absolutely do not expect the financial gravity to just invent.
Mm.
You don't expect a 47-year-old hardware manufacturer to suddenly post a quarter that makes them look like a cloud software startup that just discovered infinite scale.
Because, well, in the physical world, scale isn't infinite.
Mm-hmm.
I mean, to sell one more chip, you actually have to build one more chip.
Yeah.
That means paying for raw silicon wafers, ultra-pure chemicals, the massive electricity bills to run a multi-billion-dollar fabrication plant, and the labor to maintain it. The unit economics of hardware are supposed to be heavy. They're grinding.
Which is exactly why I am still struggling to wrap my head around the numbers we are dissecting today. So we are pulling this from episode 11 of a research brief called Behind the Moat, and we're focusing on Micron Technology, ticker symbol MU.
One of the world's 3 dominant makers of memory chips.
Yeah, one of the big 3. Now, before we get into the mechanics of how a physical factory spits out an 85% margin, and before we reveal the massive counterbet that makes this story so fascinating today, we need to do some mandatory housekeeping.
Right, the disclaimer.
Exactly. Because we are diving into specific stock prices, explosive market moves, and valuation multiples today, I have to make this crystal clear right at the top for everyone listening. This deep dive is purely for educational purposes.
Yep.
It is not investment advice. We are not recommending that you buy or sell any security, and, we are absolutely not giving you price targets.
And it is so critical to keep in mind that any valuation figures or financial projections we analyze today, they're purely illustrative. They are not forecasts of what will happen.
Definitely not.
Past performance does not predict future results, especially in a sector with the kind of historical volatility we are going to unpack today. You must do your own research and consult a licensed financial professional before making any investment.
Always. And also, just for full transparency, the author of the Behind the Moat brief we are sourcing from today may or may not hold a position in Micron. Our mandate here is just to extract the facts, the arguments, and the underlying logic of the source material.
Exactly.
So with the disclaimer handle, let's go back to a very specific date. June 24, 2026, Micron reported its quarterly earnings. And they didn't just beat Wall Street's estimates. They completely shattered the historical parameters of the semiconductor industry.
It was a shockwave.
Yeah, they posted $41.5 billion in revenue for a single quarter.
Which, just to put that into perspective for you, that is a 346% increase year over year.
It's absurd.
It is. I mean, for a mature incumbent giant to more than quadruple its revenue base in 12 months is practically unheard of in modern industrial history.
And the revenue wasn't even the most shocking part. It was the profitability on that revenue. They reported a non-GAAP gross margin of 84.9%.
Wow.
Yeah, when I read that in the source material, I had to stop and reread it. Almost 85 cents of every dollar they brought in was gross profit.
Right, which is a margin profile you expect from a company selling a digital subscription, right?
Yeah.
Where the cost of duplicating the software is literally zero.
Exactly. Not a company operating clean rooms that cost billions of dollars to construct.
It's an anomaly.
Yeah.
It really forces you to question whether the fundamental nature of their product has somehow changed. And, well, the market certainly thought it had.
Oh, the market went entirely euphoric. The very next day, Micron stock hit an all-time high of $1,213.56. So we are in late June 2026.
Right.
The stock is soaring past $1,200. The consensus is that the AI revolution has turned Micron into a money printing machine.
But then comes the twist.
Right. The source material highlights a massive disruption to that narrative just 1 week later, on July 2.
Yeah, Michael Burry, the investor famous for anticipating and shorting the 2008 housing crash, from The Big Short. He publicly disclosed a massive short position against Micron.
He shorted the stock at $1,051.87.
Right.
Wait, so he looked at a company growing revenue by 346%, posting 85% margins, and decided that was the exact moment to bet against them. What was his rationale?
He essentially called the entire AI memory excitement a mirage. In his view, this is just a fear of missing out bubble, basically FOMO dressed up as a technological paradigm shift.
Wow.
He argued that beneath the AI hype, Micron is still operating in a fundamentally cyclical, brutal commodity market, and that these record numbers are just the peak before a devastating crash.
And when a contrarian with his track record makes a public bet like that against the market's favorite darling, I mean, institutional money pays attention.
Oh, absolutely. The stock closed that same week down at $975.56.
Which perfectly sets up the central question we are going to explore with you today. This is the entire focal point of our deep dive. Has artificial intelligence fundamentally and permanently changed what a memory chip is actually worth?
Right.
Or are we simply looking at the loudest, most deceptive, most spectacular peak yet in an industry that has reliably crashed every few years for the last 4 decades?
And answering that requires us to actually understand what it is that Micron physically manufactures. We can't just throw around the word memory or AI chips as if they are monolithic concepts.
Yeah, that gets confusing fast.
It does. We have to look at the engineering bottleneck that created this $41.5 billion quarter.
So the source material offers a really useful analogy to separate the different types of memory. I want to lay this out quickly to ground the discussion, but then I want to push past it because the real story here is the physics.
Let's hear it.
Okay, so if we imagine a standard computer as a busy office building, you basically have 3 main areas. Down in the basement, you have the archive room. It's dark, it's permanent. If you put a file in a cabinet down there, it stays forever, even if the power goes out.
Right. And in your computer, that's the SSD, the NAND flash storage. It holds your operating system and all your files.
And retrieving data from that basement takes time.
Exactly. It's relatively slow.
Right. Then upstairs, you have the worker at a desk. The worker is the CPU, the central processing unit. Brilliant, capable of solving any complex sequential logic problem, but works entirely alone.
Just one genius at a desk.
Yep. Finally, you have the desk itself. This is where the worker spreads out the active files they are looking at right now. It is incredibly fast to read a file sitting on your desk, but at the end of the day, the desk is wiped completely clean.
So that desk is your RAM, specifically DRAM. And Micron makes both the basement archive, the NAND, and the desk, which is the DRAM. And that analogy perfectly illustrates what we call the von Neumann bottleneck, which is the foundational problem in computer science.
The von Neumann bottleneck. Okay.
Yeah. The genius worker at the desk, the CPU, can only work as fast as they can grab files off that desk. If you only have 8 gigabytes of RAM, your desk is tiny.
So if you open like 30 browser tabs,
the desk fills up, the worker has to stop calculating, walk down to the basement, swap files out, and walk back up. That physical delay is the latency you experience when a computer freezes or slows down to a crawl.
Okay, so if we take that standard office setup, how does an AI data center break it? Because, consumer PC sales didn't suddenly jump 300% this year. People aren't just buying way more laptops.
No, not at all.
Yeah.
The architecture of the office fundamentally changed because the nature of the math changed.
Math changed.
Yeah. Training a large language model doesn't require a single genius CPU doing complex step-by-step logic. It requires performing billions of very simple probabilistic calculations simultaneously. So for the heavy lifting in an AI data center, you don't use a CPU. You use a GPU, a graphics processing unit.
And a GPU isn't a single worker.
Not even close. A modern AI GPU is the equivalent of taking that office, firing the single genius, and packing 17,000 very basic workers into the exact same room.
17,000 workers.
Right. You take a massive mathematical matrix, break it into 17,000 tiny fragments, and hand one piece to each worker to solve at the exact same instant. That is parallel processing.
But wait. If you put 17,000 workers in a room and they all have to share that one single standard-sized DRAM desk to get their files, that's not just a bottleneck, that's a total systemic collapse.
Exactly. They would all just be standing around waiting for data.
Which is exactly why a $30,000 NVIDIA GPU is a marvel of silicon engineering, sure, but it is entirely useless if it is starved for data.
Precisely. If the memory can't feed the processor fast enough, that multi-million-dollar data center you just built is functionally just a very expensive warehouse full of space heaters. The processing power is completely irrelevant if the data delivery mechanism is congested.
So how did they solve the traffic jam? Because clearly they did, otherwise Micron wouldn't be posting these numbers.
They solved it by engineering a completely new architecture for the desk called HBM, high bandwidth memory. And this is where we have to look at the advanced physics of semiconductor packaging, because HBM is the specific product that drove Micron's record quarter.
Okay, let's get into the mechanics of HBM then, because on a chemical level, the source material notes it's still DRAM. It's the same volatile memory technology they've been iterating on for decades, right?
The underlying storage cells are similar, yes, but the way they move the electrical signals is radically different. In a traditional computer, you have the processor chip here, and a few inches away on the green motherboard, you have a stick of standard RAM.
Right, the usual setup.
Yeah. So to move a file, the electrical signal has to travel horizontally across the copper traces on the motherboard. When you are trying to feed 17,000 workers simultaneously, pushing that much electrical current across physical horizontal distances generates massive amounts of heat and requires too much power. It's just too slow.
So you can't just put more standard RAM sticks next to the GPU.
It physically wouldn't work. The latency of traveling across the motherboard is too high. So the engineers went vertical.
Vertical.
Yeah. With HBM, they take the DRAM memory chips, thin them down until they are practically microscopic, and stack them on top of each other, 8, 12, sometimes 16 layers high, like floors in a skyscraper.
But stacking them creates a new problem, right? How does
Exactly.
the top layer communicate with the bottom layer without wiring running all down the outside of the stack?
And this is the engineering miracle of HBM. They use a technology called through-silicon vias, or TSVs.
Yeah.
They literally drill thousands of microscopic holes straight down through the entire stack of silicon and fill those holes with conductive metal. Yeah, this creates thousands of vertical, parallel channels for the data to travel through simultaneously.
Okay, so instead of a single flat desk, you have a multi-story tower equipped with thousands of pneumatic tubes shooting data straight up and down. But, you still have to connect that tower to the GPU itself.
And that's the final piece of the puzzle. They don't put this HBM tower across the motherboard. They place it on the exact same piece of silicon packaging called an interposer, literally micrometers away from the GPU. The electrical distance the data has to travel goes from inches to micrometers.
So that reduction in physical distance is what unlocks the speed.
Precisely. Let's look at the bandwidth jump. A standard high-end 16 gigabyte stick of DDR5 RAM, the kind you'd put in a really great gaming PC, might move data at roughly 50 to 100 gigabytes per second.
Okay.
HBM, on the other hand, moves data at thousands of gigabytes per second. It's a completely different paradigm of throughput. It is a desk built specifically for 5,000 workers to use simultaneously with zero waiting.
And the demand for that specific architecture is what created the anomaly. The brief notes that HBM is completely sold out for 2026, and the order book is entirely filled through the entirety of 2027.
It's gone. Token for.
Right. If you are building an AI data center right now, you have no choice. You must buy HBM.
Which brings us to a really critical tension in the market. If you have a product that is entirely sold out for years in advance and it commands an 85% gross margin, well, basic capitalist theory dictates that competitors should be rushing into the market to capture that profit.
Right. If someone is making 85 cents of profit on every dollar, someone else should come in, accept a 60% margin, and steal the market share.
Exactly.
I want to explore that because the source material poses an incredible thought experiment that gets right to the heart of Micron's moat. I'll frame it as the $10 billion question.
Okay, lay it out.
Imagine you are a hyperscaler with effectively unlimited capital. Let's say you are Google or Microsoft. You look at Micron's 85% margins and you think, we are getting gouged on memory pricing. We have $50 billion in cash sitting on our balance sheet. Let's just bypass Micron, write a $10 billion check, build our own state-of-the-art memory fabrication plant, and manufacture our own HBM. Why can't they do that?
Because a check for $10 billion doesn't buy you the one thing that actually matters in semiconductor manufacturing.
Which is?
Yield. The moat around this industry isn't just financial capital, it's time, and it's accumulated institutional knowledge.
Let's dig into yield, because that is the defining metric of a fab.
Yeah.
$10 billion definitely buys the physical building. It buys the extreme clean rooms. It buys the lithography machines from ASML that cost hundreds of millions of dollars each. Why doesn't it buy functional chips?
Because manufacturing advanced memory is arguably the most complex physical process human beings have ever commercialized.
Right.
Yes. You are taking a pure silicon wafer and putting it through over 1,000 distinct chemical and optical process steps over the course of 3 months. You are etching patterns into the silicon at the nanometer scale.
That's unfathomably small.
At that scale, if a single microscopic speck of dust gets into the clean room, or if the temperature of a chemical bath fluctuates by a fraction of a degree, or if the timing of a plasma etch is off by a millisecond, you ruin the entire wafer.
So when you turn on a brand new $10 billion fab, what happens on day one?
Your initial yield, which is the percentage of chips that actually work without defects, might be 10%, maybe 20% if you are incredibly lucky. You are spending billions of dollars to manufacture highly toxic, highly expensive silicon garbage.
Wow.
Yeah. The process of getting that yield from 20% up to the 90+% required to actually make a profit is an excruciating game of trial and error. You have to tweak the chemistry, analyze the defects, adjust the lithography, and try again.
And you can't just, hire a consultant to give you the recipe.
Yeah. No, because the recipe is inextricably linked to the specific tools in the specific environment. The knowledge of how to push the physics forward lives in the heads of engineering teams who have spent the last 30 years failing and iterating. The three companies that dominate this space have spent decades co-developing the manufacturing tools alongside the equipment vendors. Google can't just buy 30 years of accumulated process engineering overnight.
But let's play devil's advocate for a second. Let's say Google is incredibly patient. They spend the $10 billion, they hire a rogue team of engineers, they spend 5 years dialing in the process, and miraculously, they achieve a 95% yield on HBM. They have perfect chips. Are they in the market now?
Still no.
No.
No, because producing the chip is only half the battle in the enterprise memory market.
Right.
Once you have a perfect chip, you have to go through customer qualification. NVIDIA or AMD isn't just going to buy memory from a new supplier and slap it onto a $30,000 GPU without extreme vetting.
Oh,
The qualification process involves subjecting your HBM to intense thermal and electrical stress testing for months to ensure it performs flawlessly over millions of cycles.
because if the memory fails, the entire $30,000 AI chip has to be thrown away.
Exactly. The HBM is physically fused to the GPU on the interposer. You can't just unclip it and put a new RAM stick in. If the memory dies, the GPU dies. So the customer qualification cycle alone takes another 1 to 2 years after your factory is running perfectly. The barrier to entry is this impenetrable compounding loop of massive capital requirements, extreme technical difficulty, and unavoidable time delays.
Which perfectly explains how we ended up with what the brief calls the Survivors Club. If we look back at the 1990s, during the initial explosion of personal computing, the memory market was a bloodbath. There were over 20 different companies manufacturing DRAM.
It was incredibly crowded.
But because the capital expenditures are so punishing and the technical hurdles compound with every generation of miniaturization, almost all of them either went bankrupt or were consolidated.
Today, out of those 20-plus companies, there are exactly 3 left operating at a global scale. It is an incredibly consolidated oligopoly.
The source material breaks down the market share, and this is where it gets really interesting. In standard DRAM, the commodity memory that goes into normal laptops and servers, you have Samsung leading with roughly 39% of the market.
The undisputed king of volume.
Right. SK Hynix is in second with about 29%, and Micron is the smallest of the big three with about 22%. Combined, they control roughly 90% of the world's memory supply. But when we look at HBM specifically, that leaderboard completely inverts.
It does. While the moat protects all 3 of them from outside competition, the fight inside the moat is fierce. In the highly lucrative HBM space, SK Hynix is dominating with roughly 62% market share.
62%?
Yeah. They anticipated the AI bandwidth bottleneck years ago and built an incredibly deep co-engineering relationship with NVIDIA. Micron, despite being third in standard memory, leaped into second place in HBM with about 21%.
And Samsung, the undisputed king of volume memory, is suddenly lagging in third place with only 17%, struggling to get their latest generation of HBM fully qualified. How did Samsung fall behind in their own domain?
It came down to a highly technical packaging choice. When you are stacking silicon layers with microscopic TSVs, heat dissipation is a massive problem. The chips want to warp under thermal stress.
Sure, that makes sense.
SK Hynix adopted a technique called mass reflow molded underfill, which essentially injects a liquid epoxy between the layers to hold them rigid and dissipate heat during the soldering process.
Okay.
Samsung tried a different method called thermal compression bonding. Hynix's method yielded better thermal performance for the intense heat generated by AI workloads, giving them the edge in qualification.
That level of microscopic engineering is what separates a 62% market share from a 17% market share. That's wild. Now, before we move on to the demand side of the equation, there is a fundamental misconception we have to clear up. I hear people casually talking about the AI arms race, and they often frame it as NVIDIA versus Micron.
Oh, I hear that all the time.
The assumption is that they are both making chips, so they must be competing for data center dominance.
That is a total misunderstanding of the semiconductor ecosystem. Micron and NVIDIA do not compete in any way. In fact, their relationship is entirely symbiotic.
Going back to the analogy, NVIDIA designs the blueprint for the 17,000 brilliant workers. They design the GPU logic. But NVIDIA does not manufacture memory.
No, they don't touch memory.
They rely entirely on companies like Micron and SK Hynix to build the massive multi-level high-speed disk. When a cloud provider buys an AI accelerator, they are buying a single package of silicon, but it contains NVIDIA's logic paired directly with Micron or Hynix's HBM. There are two halves of the same brain. You cannot train modern AI without both sides functioning perfectly. Okay, so we've established the engineering miracle of HBM, the insurmountable barrier to entry, and the oligopoly controlling the supply. Let's look at the demand runway. Because if you are a bull on Micron stock, if you think buying at $1,200 a share is totally justified, you're looking at a growth story that seems completely unconstrained.
Right. The bullish argument for demand rests on two distinct pillars. First is the structural shift we just outlined. HBM is no longer an optional upgrade. Every single advanced AI accelerator fundamentally requires it.
Yep.
But the second pillar is where the financial explosion actually happens. HBM commands a massively higher average selling price, or ASP, than ordinary DRAM.
The premium is enormous. So even if the total physical volume of silicon wafers Micron processes stays exactly the same, the revenue skyrockets simply because the mix of what they are selling has shifted heavily toward this ultra-premium high-margin product. They are extracting vastly more value per square inch of silicon.
And we have to ask who is actually absorbing those premium prices? Who is funding this $41.5 billion quarter?
Right. It's not consumers upgrading their iPhones. The buyer pool is highly concentrated. It consists almost entirely of the hyperscalers, Amazon Web Services, Microsoft Azure, Google Cloud, Meta, and the custom chip designers like NVIDIA and AMD who supply them.
A very short list of customers.
Exactly. These massive tech titans are engaged in an existential arms race to build the biggest artificial intelligence infrastructure on the planet. They are buying every single HBM stack they can get their hands on, regardless of price, because the cost of falling behind in AI capabilities is viewed as corporate suicide.
But that buyer pool is exactly where the structural vulnerability of this entire narrative lies.
I want to push on that, because the bulls look at this forward order book filled through 2027 and see guaranteed revenue. But I look at that buyer pool and I see a terrifying concentration risk. If Apple sells iPhones, they are selling to 1 billion individual consumers worldwide. If consumer sentiment softens, maybe sales dip 3 or 4%, it's a highly diversified revenue stream.
Yeah, a broad base.
But Micron's 346% revenue growth rests on the infrastructure capital expenditure decisions of a tiny handful of corporations. You have an oligopoly of sellers selling to an oligopsony of buyers.
That's the perfect term for it, an oligopsony, a market with incredibly few buyers. You are entirely at the mercy of their CapEx budgets.
Let's play out a very realistic scenario. Let's say it's early 2027. Microsoft and Google look at their data centers. They've spent hundreds of billions of dollars over the last 3 years building out this AI infrastructure, but the software applications they are trying to sell on top of that infrastructure, the enterprise AI subscriptions, aren't generating enough revenue to justify the continued build-out.
Which is a very real possibility.
So the CFOs of these hyperscalers decide they need to pause. They say, let's halt our HBM orders for the next 3 quarters while we digest what we've already built. What happens to Micron in that scenario?
The financial consequences for Micron would be devastating, and it all comes down to the brutal reality of operating leverage in hardware manufacturing. To understand why a pause in orders is so catastrophic for Micron, we really have to contrast their business model with their partner, NVIDIA.
Let's do that. Because they sit on the same piece of silicon, but their financial architectures are on opposite ends of the spectrum. NVIDIA operates on what is called a fabless model.
Fabless meaning they do not own the fabrication plants. NVIDIA is fundamentally a design and intellectual property firm. They employ brilliant engineers to draw the incredibly complex blueprints for the GPUs. Then, they send those blueprints to TSMC, the Taiwan semiconductor manufacturing company, and pay them to actually physically manufacture the chips.
Got it.
NVIDIA itself does not own the multi-billion-dollar clean rooms, they don't buy the raw silicon, and they don't run the chemical etching processes.
They just design the logic and collect incredible margins on the IP. But Micron is an integrated device manufacturer, or IDM. They design the memory and they physically manufacture it in their own fabs, and that makes the business incredibly heavy.
Look at the capital expenditure figures in the source material. Micron's CapEx, just the cash they are spending to build new fabs, upgrade clean rooms, and buy new lithography machines, is on pace to pass $25 billion this year alone. That is $25 billion of cash out the door before they sell a single chip from those new lines.
Now, owning your own fabs does provide a strategic advantage, especially right now. Because they aren't entirely reliant on TSMC in Taiwan, they have a degree of geographic diversification. With fabs in the US, Japan, and elsewhere, they have some insulation against geopolitical shocks in the Taiwan Strait that would instantly paralyze a fabless company like NVIDIA.
That supply chain security is valuable, sure, but it requires taking on massive fixed costs. And this is where operating leverage becomes a double-edged sword.
Explain operating leverage for us.
Operating leverage essentially measures the ratio of fixed costs to variable costs. In a semiconductor fab, your costs are almost entirely fixed. You have to pay the multi-billion-dollar depreciation on the facility. You have to pay the massive electricity bills to maintain the clean room environment 2047. You have to pay the highly specialized engineers.
The costs don't care if you are running the factory at 100% capacity or 50% capacity.
Exactly. The variable cost, the actual raw silicon and chemicals for one additional wafer, is incredibly low compared to the fixed overhead of the building itself. When demand is booming and the factory is running at 100% utilization, every additional chip sold drops almost pure profit to the bottom line. That high operating leverage is how a hardware company mathematically achieves an 84.9% gross margin.
But operating leverage works in reverse, and it is merciless. Let's go back to our scenario where Microsoft and Google pause their orders. If the orders stop, Micron can't just easily throttle back the factory. They can't just shut the fab down for a month to save money because powering down and recalibrating the hypersensitive equipment costs billions in lost yield when you try to turn it back on.
Right. The fixed costs continue to drain the balance sheet, regardless of whether anyone is buying the output. So what do you do if you are Micron and the hyperscalers stop buying? You have to keep the fab running, which means you start piling up inventory. You produce millions of chips that sit in warehouses.
And when supply balloons while demand evaporates, the basic laws of economics take over. Memory prices crash.
This isn't just theory. We don't have to speculate about this because we have seen it happen repeatedly. This is exactly what Michael Burry is looking at when he takes his short position. The history of this industry is a series of violent boom and bust cycles, driven by that exact dynamic of high fixed costs meeting fluctuating demand.
Let's look at the history then. The source material highlights the two most recent examples. Let's talk about the crash of fiscal 2019.
The 2019 crash was a classic cloud digestion cycle. In the years leading up to 2019, the hyperscalers were aggressively building out traditional cloud infrastructure. They feared a memory shortage, so they overordered. They literally double-booked orders with suppliers just to ensure they had enough inventory.
And that hoarding behavior artificially inflated demand, which drove the spot price of DRAM through the roof. Micron posted incredible earnings, and the market thought it was a new paradigm. Sounds familiar.
Yeah, very familiar. But then reality set in. The hyperscalers looked at their warehouses, realized they had amassed a massive stockpile of memory, and they abruptly halted orders to work through their existing inventory. They just shut off the tap.
Because Micron's fabs were still pumping out chips at maximum capacity, the market was instantly flooded with oversupply. The price of memory collapsed. Micron's revenue fell by roughly a third in a matter of quarters. Margins compressed instantly as they had to slash prices just to move inventory off the balance sheet.
It was painful.
Losing a third of your revenue is brutal. But the brief notes that the crash of fiscal 2023 was even more devastating. Walk us through that one.
2023 was a perfect storm. We had a massive post-pandemic slump in consumer PC and smartphone sales, colliding simultaneously with another round of data center digestion. Demand didn't just soften, it practically vanished.
Wow.
But again, Micron had already laid out the capital expenditures. They had already built the capacity. Because they couldn't turn the fabs off without catastrophic restart costs, they kept producing memory into a market that absolutely did not want it.
I remember looking at the inventory days outstanding for memory makers during that period. It was staggering. They had months and months of unsold product depreciating in value every single day because technology gets obsolete so fast.
The pricing environment went into a free fall. Micron's revenue didn't just dip, it nearly halved. The operating leverage that creates 85% margins in a boom worked in reverse, dragging them into a massive $5.7 billion operating loss.
By $7 billion. That is
Yeah.
huge. Yeah, they went from peak profitability to a multi-billion-dollar crater in less than a year.
And they had to take massive inventory write-downs. That is the ultimate commodity trap. When your production output is entirely inelastic, meaning you can't reduce supply quickly, even a modest 10 or 15% drop in end customer demand leads to an outsized, massive plunge in the actual market price of the chips. The margins evaporate overnight.
Now, add to that structural economic fragility a layer of geopolitical risk, and you start to see why this business is so volatile.
Yes, the source material points out that semiconductor manufacturing is caught directly in the crosshairs of global trade wars. And this political risk is a two-way street that can wipe out massive revenue streams by government decree, totally independent of market demand.
Let's look at the U.S. side first. The U.S. government views AI supremacy as a matter of national security. In December 2024, they tightened export controls significantly. These regulations effectively blocked Micron from selling its most advanced HBM products to Chinese tech companies. Regardless of how much a Chinese firm is willing to pay, Micron cannot legally ship them the chips. That instantly cuts off a massive potential market.
But the weaponization of the supply chain goes both ways.
Yeah.
The brief notes that in 2023, the Cyberspace Administration of China retaliated. They banned Micron products from being sold to operators of any critical information infrastructure in China, citing vague cybersecurity risks.
So you have governments on both sides of the Pacific actively dictating who can buy your product. A single policy change in Washington or Beijing can cause $1 billion in projected revenue to simply vanish overnight.
It's a huge wild card.
So if we synthesize all of this, the incredible engineering of HBM driving 85% margins, juxtaposed against the heavy reality of $25 billion in fixed capex, the brutal history of demand crashes, and the geopolitical wildcards, we arrive at the core debate over Micron's valuation.
This is where it all comes together.
We are going to break down the bear case, the bull case, and the base case impartially, based on the source material. And to do that, we have to look at how the market is actually pricing the company right now.
The valuation is the battlefield where these two narratives collide. And interestingly, depending on which financial multiple you choose to look at, the stock either looks reasonably priced or terrifyingly overvalued.
Let's start with the standard metric everyone knows, the price-to-earnings ratio, or PE. Currently, Micron is trading at roughly 22 times its trailing earnings. Now, if I am a casual investor looking at a stock screener, a 22x PE sounds totally reasonable. Honestly, it sounds cheap.
Yeah, relatively speaking.
We are talking about a company that just grew its top line by 346%. You have slow-moving consumer packaged goods companies selling soap and toothpaste that trade at 25 or 30 times earnings. So 22x for an AI powerhouse seems like a bargain.
It looks like a bargain if you assume those earnings are stable. But if you switch metrics and look at the price-to-sales multiple, a completely different picture emerges. Micron is currently trading at roughly 12 times its trailing sales.
And that multiple is the blaring red alarm for traditional value investors. A 12x price-to-sales multiple means the market capitalization is 12 times the total revenue the company generates in a year.
Right.
That is a valuation multiple normally reserved for high-margin, capital-light software-as-a-service companies with recurring subscription revenue.
It implies that investors believe Micron's current 85% margins are permanent and that they will continue to extract software-like profitability from a hardware manufacturing process indefinitely.
Which brings us directly to Michael Burry's bear case. Walk us through the pessimistic argument. Why does he look at that 22x PE and see a mirage?
The bear case is built on the belief that the laws of financial gravity have not been repealed. Burry is looking at the long-term track record of capital destruction in the memory industry. The source material notes a staggering statistic. Historically, Micron's stock has suffered a crash of more than 30% on 34 separate occasions over its 42-year history.
34 distinct crashes of 30% or more. The volatility is baked right into the DNA of the business.
Furthermore, if you look at their return on invested capital, the actual profit they managed to generate over a full cycle compared to the billions they pour into these fabs, it averages out to just 4%.
4%. You can buy a risk-free government treasury bond right now and yield close to that. You aren't getting compensated for the massive risk of operating a semiconductor fab.
Exactly. The bears argue that this is fundamentally a business that periodically destroys the capital it raises. Their fear regarding the current situation is simple. HBM is an incredible technological achievement today, but eventually it will succumb to the exact same commodity cycle dynamics as every other memory product in history.
Meaning that the supply constraint will inevitably ease.
Right. Samsung and SK Hynix are not standing still. They are pouring tens of billions into expanding their own HBM capacity. The bears believe that within a year or two, that new capacity will come online just as the hyperscalers finish their initial AI build-out and pull back on orders. The market will flood with HBM, the scarcity premium will evaporate, the 85% margins will collapse, and earnings will drop 70 to 80%, just as they did in 2023.
And if earnings drop 80%, that reveals the illusion of the PE ratio. I want to highlight this concept for you listening because it is crucial for analyzing cyclical stocks. The cyclical trap. With highly cyclical commodity businesses, they always look the absolute cheapest on a price-to-earnings basis at the exact peak of the cycle right before they crash.
Because the E in the equation, the earnings, is at an unnatural, mathematically unsustainable peak due to the temporary supply shortage.
If the stock is at $1,000 and the earnings are $50 a share, your PE is 20. It looks cheap. But if the cycle turns next year, the fixed costs of the fab crush the margins, and earnings drop to $10 a share. The stock price doesn't stay at $1,000. That would imply 100x PE. Instead, the market ruthlessly reprices the stock downward to maintain a normal multiple. The stock craters to $200. In the bear view, buying Micron at 22x earnings today is stepping directly into a cyclical trap, assuming peak earnings are a permanent plateau.
But the bulls vehemently reject that premise. Let's examine the optimistic case. Why do the bulls believe this time is actually fundamentally different?
The bull case argues that the advent of generative AI represents a permanent structural shift in compute architecture. They argue we aren't just in a temporary upgrade cycle like 5G phones or a crypto mining boom. The transition to accelerated computing using GPUs requires massive sustained memory bandwidth that cannot be solved by older technologies.
But more importantly, the bulls argue that the commercial structure of the business has evolved to protect Micron from the devastating crashes of the past.
This is the key defense against the cyclical trap. In 2019 and 2023, standard DRAM was largely sold on the spot market, almost like an agricultural commodity. Prices fluctuated wildly based on daily supply and demand. If the market was flooded, you had to take whatever price was offered that day.
But HBM is completely different. Because the engineering is so bespoke and the qualification process is so intense, it is not sold on a volatile spot market. The source material emphasizes that HBM is sold under multi-year, non-cancelable contracts that are co-designed with the customers years in advance. We already noted that Micron's HBM capacity is fully booked through 2027.
So the bulls argue that Micron has unprecedented forward visibility. They aren't just blindly manufacturing chips and hoping the market wants them. They have signed contracts locking in the demand and the pricing for years to come. That dampens the risk of a sudden inventory glut.
Furthermore, the bulls point to the geopolitical situation as a protective moat. A major fear in any commodity market is cheap Chinese competition flooding the supply. But the bulls argue that state-backed Chinese players, like CXMT, are years behind in the extreme advanced packaging required for HBM, and strict U.S. sanctions on lithography equipment will ensure they stay behind. Therefore, the oligopoly of the big three is secure.
So in the bullish framework, this 22x PE is not a cyclical trap. The current earnings profile is not a temporary peak to be feared. It is a new permanent baseline. And if those earnings are sustainable, then paying 22 times earnings for a company with this kind of top-line growth is entirely justified.
Which leads us to the base case, the middle path that attempts to reconcile these two extremes.
The base case acknowledges that the bulls are right about the structural demand for AI bandwidth, but the bears are right that hardware physics eventually dictate a return to mean profitability.
The base case suggests that the violent boom and bust cycles of the past will likely be dampened by the shift toward these multi-year HBM contracts. We may not see the devastating 80% earnings craters of 2023 because the HBM revenue floor is more secure.
However, the cycle is not entirely eliminated. Why? Because despite the hype, the vast majority of Micron's physical output is still standard DRAM and NAND storage. They are still highly exposed to traditional consumer PC, smartphone, and standard server markets. If the global economy slows down, those segments will still suffer inventory gluts and spot market crashes.
The base case envisions a future where Micron still experiences cycles, but perhaps with higher troughs. The crashes won't be as deep, and the average return on invested capital over a decade might inch up from that historical 4% to something more respectable, though perhaps not enough to justify a permanent 12x price to sales multiple.
It is a phenomenal debate, balancing deep technological shifts against the iron laws of industrial economics. And honestly, if you are listening to this and you want to dig into the actual numbers yourself, if you want to test these theories, there is an incredible analytical tool available for you. You can go to the site behind-the-moat-v2.web.app. There you will find the full, comprehensive written brief for episode 11 that we used today.
The site is an exceptional resource. You can access detailed 20-year historical financial data for Micron and all the other companies they cover. But the most valuable feature is the interactive valuation workbench.
The workbench lets you move the variables yourself. You don't have to take the bull or the bear's word for it. You can plug in your own assumptions. You can model a scenario where those 85% margins hold for 3 years, or you can model a scenario where they normalize back down to historical averages in 18 months. The tool instantly calculates what that implies for the valuation of the company. It allows you to mathematically stress test the cyclical trap argument for yourself. Again, that is behind-v2.web.app. Let's step back and look at the whole board. We have unpacked the mechanics of a $41.5 billion quarter. We explored the physics of replacing a single worker with 17,000 parallel processors and the necessity of drilling microscopic through silicon vias to build the HBM tower.
We examined the massive $10 billion barrier to entry defined by yield and time, the brutal historical cycles driven by heavy operating leverage, and the profound divide between the bulls who see a new paradigm and Michael Burry who sees an impending crash.
We are not declaring a winner here today. The market will resolve this tension in real time over the next few years.
The underlying facts support both narratives simultaneously. We're witnessing a profound, undeniable technological leap in data processing, occurring inside an industry with a 4-decade history of punishing, inescapable cyclicality. The friction between those two realities is what makes this specific moment in semiconductor history so compelling to analyze.
Which leaves us with one final thought to close out. I want to bring you back to the morning of June 24, 2026. The morning those unimaginable numbers hit the wire and the stock soared. I want you to think about this question, to really mull it over on your own as you watch this sector evolve. When financial historians look back 10 or 20 years from now at this massive $41.5 billion quarter, will it be remembered as the exact defining moment when memory chips finally broke free from their past, transcended the physical limitations of their factories, and stopped behaving like a cheap commodity? Or will it be remembered as simply the loudest, most spectacular, most deceptive peak yet in a heavy, grinding business that always comes crashing back down? It's a question worth diving into.